I would say, yeah, 100%. And yet I don't qualify income. That will be like that was the easy with the check too. Like I could have been so avoided that. Oh yeah. Yeah. No, I totally just dig out shit.
Okay, in case you need the reminders, your final exam is day after tomorrow from 4 p.m. to 5:50 p.m. I noticed, there is that online, version for those people who cannot take it in person. For those who are taking it in person, again, I'll send you room assignments tomorrow. I will also have office hours tomorrow from 9:30 a.m. to 11 a.m. for anybody who has questions about the final exam. So all of that information with the link will come after class today. Any questions before we start? By now, I was looking at the submissions coming in. I think about 2/3 of you have already sent it in. So it's a relief, I'm sure, to get it off. Simply because as you hold it, the market keeps shifting on you, right? You're afraid if you hold it for 20 minutes more, your stock will go from overvalued to undervalued to even more undervalued. So I'll let you work it out. But today I thought I would use this session to both review the class. I'm going to use a very unconventional way of reviewing the class and use your numbers to kind of present them back to you so you can see what you found in the class. So at the start of the class, remember I said there were 3 ways you could put a number on your company: intrinsic valuation, pricing, and options. Intrinsic valuation, you value a company based on it as a business, its cash flows, its growth, its risk. Discounted cash flow valuation is the model or the tool we use to do it, but it's not the only way. Intrinsic valuation is about buying a business, running it as a business, collecting the cash flows, and making sure you get enough cash flows to justify the price you paid up front. Pricing, you attach a number to a business based on what other people are willing to pay for similar businesses. Very different philosophical perspective. And you can see the 2 approaches can give you different numbers, as you found for your own company, right? You did the DCF and a pricing, you got different numbers. For about 1 in 5, 1 in 10 companies, you might find that there is a contingent cash flow. If something happens, a cash flow kicks in. A pharmaceutical company with a drug working its way through the pipeline. An oil company with undeveloped reserves that are not viable right now, but the price increases enough they could be viable. You could use an option pricing model, and what they share in common is they allow you to pay a premium on top of your DCF model. So let's step back. All of this complexity we built into DCF. If you bring it back to basics, these are the inputs that drive the value of your company. First, we look for cash flows from existing assets, investments you've already made as a company. To collect those cash flows or estimate those cash flows, we start with after-tax operating income because we're looking at the entire business. And from that, we subtract out what we need to reinvest back in the business so that it can grow. That reinvestment can be broken down into net CapEx and change in working capital, which in turn can include acquisitions, R&D, all that stuff is in there. But you're subtracting out reinvestment to get to free cash flow. So the first driver is cash flows. Of course, you could do this all from the perspective of equity investors. In this case, all you do is bring out interest expenses and debt payments, and that makes free cash flows to firm into free cash flows equity. That's your first stop. The second stop is perhaps the trickiest one in valuation. I ask you, what's the value you're going to create or destroy with future growth? Why? Because growth has its upside. It makes your revenues and earnings bigger, but its downside is you got to reinvest money to get that growth. The net effect can be positive or negative. To discount those cash flows, you need a discount rate. And this is the only place in valuation where risk plays a role, right? Everything else is expected. You're acting like a risk neutral person, but then you wake up and say, I'm risk averse, therefore I need to get a higher required return if it's riskier. The discount rate captures the risk component through the cost of equity with the beta and an equity risk premium and the cost of debt through a default spread. And of course, the way you put closure in a valuation is at some point in time, you stop and say, I'm done. But you can't ignore what happens after that point in time. You estimate a terminal value. You bring it out all back to today. You got to value the operating assets. There's a whole host of cleaning up after that you do, right? Add cash, subtract that, and God help you, we have cross holdings and all the nightmares those bring. But the end value is your value. So I was going to do a very quick review of everything we've done in DCF. And I'm going to use an artifact that is probably not always used in a valuation class. Look at this guy, Dante, this deeply disturbed Italian from the Middle Ages. Now, he actually spent a lot of his life thinking about different layers of hell. And then he wrote this extensive book, torturing us all, taking us into each layer of hell. So it's a very Catholic version of hell, right? You have sins, even bigger sins, and you have cardinal sins. You commit the cardinal sins, there's no amount of confession that's going to get you back. I'm going to take you on a trip to valuation hell. And trust me, I'll bring you back again. And the way I'm going to structure it is I'm going to start with small sins. These are the sins you can get away with, 3 Hail Marys, and then take you all the way to the deepest layers of hell from which there's no coming back. So we'll start slightly warm. That's why the color is not that red. And we'll get hotter and hotter as we get into each layer of hell. Ready? Let's start with the first layer of hell. When you did your evaluation using my Excel spreadsheet, I asked you for trailing 12-month numbers, right? For some of you, it was 2021. For some of you, it was the first quarter of 2022. And it's hard not to get caught up with those numbers. You start to think that those numbers are steady state. So what was your sales to invested capital? What was your margin? What was your growth rate? And then before you know it, it starts to feed into the rest of your valuation. It's human nature. And to show you the danger of what can happen when you do that, let me show you a very simple valuation I did in 2009. It's ExxonMobil, already a mature oil company. And in 2008, the most recent 12 months, here's what the numbers look like. They had $58 billion in after-tax operating income on revenues of $477 billion. Their net capex and change in working capital were about $4 billion. The free cash flow to the firm was $54 billion. So assume I've done my free cash flows right. So in 2008, they did have free cash flows of $54 billion. They're a mature company. I'm in 2009. I'm going to assume numbers that in 2009 were pretty reasonable numbers. I gave them a cost of capital of 8%. That was about 1.5% lower than the cost of capital of a typical company in 2009. They're safer than the typical company. And I gave them a growth rate of 2% a year in perpetuity, the inflation rate attached to oil prices. They're a mature company. They're already in stable growth. I should be able to use a stable growth model, right? The value of the company is going to be, anybody want to give me a number? 54 billion was the cash flow last year, 8% cost of capital, 2% growth rate forever. Mathematically, what would that yield me as a value for ExxonMobil? 54 would be my numerator, free cash flow of the firm. You can forget the 1 plus G. Divide by 0.08 minus 0.02, that's $900 billion. We've got a problem. You add cash, subtract our debt, I'm getting a value for the equity that's almost 2.5 times higher than the actual market cap. Either ExxonMobil is the cheapest stock in the face of the earth, or I've messed up somewhere. But there are 3 inputs in my valuation, right? One of those numbers must be screwed up. So which of these 3 numbers do you think is the culprit in why I'm getting so high a number for ExxonMobil? Let's say, is it the cost of capital? Do you think I'm underestimating the cost of capital? Could it be that ExxonMobil's cost of capital is 12, 14, 16%? I don't think so. It's not, it's not that kind of company. Could it be the growth rate? Well, I could make the growth rate 1, 0, even -3, and I'm still going to get a huge value, which leaves me with only one number. That's a problem number, which is the free cash. But I thought I got it right for 2008. So what's the question I need to ask about that free cash flow? What drives the free cash flow for an oil company? Oil prices, right? What if I told you the oil prices in 2009, when I valued ExxonMobil, were half the average oil price in 2008? By using my trailing 12-month numbers, I've almost guaranteed I'm going to find the company to be cheap, because I've used cash flows based on an oil price twice today's price. The reverse would happen if your trailing 12-month numbers reflected a high oil price and you've come down. You can already see the dangers of using trailing 12-month numbers that, you're saying, I would catch that. You're right, you might catch that. But if you're not careful about trailing 12-month numbers, you are going to see that bias feed through. It's a second example, and this is all about taxes. I want you to think about tax rates, how we compute taxes. I've given you the income statement for a company. Its EBITDA is 140 million. Its EBIT is 100 million. Taxable income of 80 million. Net income of 48 million. I'm going to tell you that this firm is a mature company with zero growth rate in perpetuity. The zero growth rate is going to be significant to you being able to get an answer. I want you to give me the free cash flow to the firm I would use in valuing the company, given its zero growth rate. First, what does a zero growth rate buy you in valuation? How does it help you? Having a zero growth rate means you don't have to reinvest, no capex, no depreciation, no working capital, right? So that's gone. So all I need is my after-tax EBIT. This should be easy, right? What's my EBIT? 100 million. So only question is, what's the after-tax EBIT? Sounds like it's right there. No, but what is my after-tax EBIT that I should be using? We got taxes of 32 million. What if I subtract the 32 million from my 100 million? That'll give me after-tax EBIT, right? What's wrong with doing that? Why can't I tell you the after-tax EBIT is 68 million? What's the mistake I'm making? Why is my tax only 32 million? Because I had interest expenses of 20 million. I've saved 8 million in taxes because of the interest expense, right? And if I include that in my cash flows and then discount it back at a cost to capital, which includes an after-tax cost for debt, I've double counted the same tax benefit. So you know what I have to do to get my after-tax operating income? I have to start with 100 million, but instead of taking the 32 million actual taxes, I should act like I have no interest expenses. And if I have no interest expenses, my taxes would have been 40 million, not 32 million. Whenever you've used EBIT times 1 minus T through this class, and you've always used it, do you know that tax was always a hypothetical tax? It's based on the presumption that you have no debt, which sounds absurd because they do have debt. But the reason we do it is when you discount back at the cost of capital, your cost of capital already incorporates the tax benefit of debt, and counting it in your cash flows is going to be double counting. So if you're ever asked to compute after-tax operating income, never net out cash taxes paid from EBIT, because you'll be double counting the tax benefits from interest expenses. Any questions? The next one is something, a graph you've seen before, but I wanted to remind you of this again. On Saturday, I got a bunch of emails from people complaining that I was being too conservative. I was stopping them from giving their company's growth lasting beyond 10 years. They said, my company is special. They said, can we? And I said, you can. I mean, it's fairly easy mechanically to extend from 10 to 15 years, but be careful what you wish for. Because most companies don't grow for 10 years. In fact, the median growth period, and this is from the graph we saw earlier, I think when we did discounted cash flow valuation, the terminal value section, the median growth period for a high growth company is about 3 to 5 years. Growth hits the skids faster than you realize, no matter how great a company is. So the 10-year growth period seems like I'm being conservative, too short a growth period, but in reality, it's probably the upper end of the spectrum. So I'm not saying you can't have a company growing for 15 years, but if you do, ask the question, what's special about the company? What does it do that other people cannot do? Okay, now I'm going to test you on cost to capital mechanics. I'm going to show you actually this. I've changed the name of the company, but I actually pulled this cost to capital calculation from an actual discounted cash flow valuation I saw. I won't name the appraiser who did it. But in the course of computing one cost of capital, this person made 6 mistakes. Let's see if you can spot the 6 mistakes as I go through. So you wanted to compute cost of capital. He started with the risk-free rate. He looked at the existing risk-free rate, which at that time was 3%, and he said, that looks too low. And he replaced it with an average T-bond rate over the last 20 years. He normalized the T-bond rate. That's the first step. For the beta, he had access to a Bloomberg terminal. He got on the Bloomberg terminal. He looked up the adjusted beta for the company. Not the raw beta, but he did look up the adjusted beta for the company. When it came to equity risk premiums, he started by looking at a historical risk premium. Remember how we look back to the last 180 years, last 90 years? At that time, the service that provided this data was called Ibbotson Associates. He got that 5% by looking at the past. And then to that, he added a small cap premium. I haven't talked about it deliberately in this class, but a small cap premium is part of valuation practice. What it is if you have a small company, to get the cost of equity for a small company, here's what appraisers do. They take risk-free rate plus beta times equity risk premium, and then they add 4%. Where did the 4% come from? I'll tell you the basis for it. It's a historical premium that small cap stocks have earned over and above the market after adjusting for risk over the last 90 years. It's pretty solid, right? They've earned 4%. That must mean they're riskier at the 4%. About 5 years ago, I took that small cap premium apart and I looked at when that premium was earned. You know, between 1926 and 1980, small cap stocks earned about 7% more than the market after adjusting for risk, 26 to 80. 1981 through 2021, the small cap premium is minus 0.2%. There is no small cap premium. But in 2022, people around the world still add a 4% small cap premium. It's gone. But this guy's doing what appraisers are doing, just adding the small cap premium because that's what every textbook on valuing companies, small companies, tells you to do. So he gets a cost of equity of 14%. To get a cost of capital, you need two things. You need a cost of debt after taxes and you need weights. Now, what should the weights be? Book value weights or market value weights? For cost of capital. Market value. And he took that lesson and he got the market value of equity. But for the market value of debt, he realized very quickly the debt was not traded. It was all bank debt. He decided to be conservative. At least that's the way he described it. And he counted all liabilities other than equity. So basically short accounts payable, supplier credit, short-term debt, long-term debt. And he came up with liabilities of $1 billion. So $1 billion in market cap of equity, $1 billion of liabilities, that gives him 50-50 weights. For the cost of debt, remember the debt is not traded. There are no ratings for the company. He used a book interest rate. What's a book interest rate? You take the interest expense and divide by the book value of debt. It's actually a trick that many appraisers use to get cost of debt. Came up with the book interest rate of 3%. And for the tax rate, he used the effective tax rate. Remember, the effective tax rate is what you get by dividing taxable income by, taxes by taxable income. As I said, there are at least 6 mistakes here. I want somebody to help me identify each of the 6 mistakes. You want to start with the first one? What's the first mistake you made? Let's start with the risk-free rate. Why should you not normalize risk-free rates? Because rates now are so low. Why don't we just replace them with something more normal? What's the intuition or reason you shouldn't be normalizing risk-free rates? You want to try? Let's say it is but you could say that about everything, right? You normalize margins, right? You pick a target, you say, we normalize everything else. Why not risk-free rates as well? What's different about risk-free rates that should make you more cautious about normalizing? Yes? They account for the inflation. Yeah, but maybe they don't account enough for inflation. You're doing the right thing. You're saying inflation is going to be higher, rates are going to be higher. I'm going to use the higher rate. Sounds like a reasonable thing to do. There was a mechanics. When I push up my risk-free rate, what do I do to my discount rate? It goes up, right? Holding all its constant, it pushes my value down, probably below the price. And then I'm not going to buy the stock, but instead of buying the stock, where in theory should I be able to invest, at least based on your model? I should be able to invest in something making 5%. God help you with that. You just made up the 5%, right? The thing about risk-free rates, it's not some abstraction, it's an opportunity cost. You might not like the fact that the risk-free rate is 3%, but whether you like it or not, this is what you will make if you don't buy the stock. Unlike other inputs, the risk-free rate is not up for normalization. 10 years from now, if you think it'll change, that's different. But today, your risk-free rate is what it is, so no normalization. Let's move to the beta. This is an easy one. We can beat this up. What's wrong with the beta? It's backward looking. It's backward looking. Let's keep going. That's the first problem. Second? Towards 1, so okay. And third, remember your statistics. When you run a regression, you get a beta. What do you have in brackets right below the beta? a standard error. It's noisy, it's backward looking. You got your ammunition ready because let's face it, you go out to, I don't know how many of you will be working at banks or consulting firms this summer. You will have people who insist on using Bloomberg betas. I wanted to take them through the process of what's wrong with the regression beta. It's one slice of history, it's backward looking, it's noisy. It's a terrible edifice on which to build a DCF structure, but people do it all the time. So what, of course, the pushback then there's a, what do we do instead? So what's your answer going to be? Look at the businesses the company's in. It's not backward looking. You can look at the businesses the company's in now. The law of large numbers brings down the noise. And as an added bonus, you can now estimate the beta for a private company because you don't need past prices. What about the historical risk premium? Small cap premium, I took apart for you. There's no small cap premium. But when I showed you the historical risk premium for the US, right? 5.13% going back to 1928. But I never used it after I showed it to you. It's one table. And then I kind of moved on. But many of the critiques of historical premiums are exactly the same critiques of betas, right? Backward looking, noisy. The standard error when you use a historical premium going back 90 years is 2%. The way to think about it is even though your risk premium is 5%, your true premium could be anywhere from 1 to 9%. So we're going to replace the normalized with the current risk-free rate. We're going to replace the regression beta with the bottom-up beta. And we're going to replace the historical premium with what? A forward-looking dynamic premium, which is the implied premium. Let's move on to the remaining inputs. The market cap of equity, that's okay. But for debt, is it conservative to pile everything but the kitchen sink into that number? What does it do when you push up the debt? Your debt ratio goes up, your cost of capital goes down, right? How is that conservative? In fact, when you use debt and the cost of capital, be narrow in your definition of debt because you expand it too much, you're going to push down your cost of capital. And in our case, we said we're going to include all interest-bearing debt, short-term as well as long-term, and lease commitments. Whether accountants do it or not, do it for them. The debt should be just that restricted notion. And finally, on the cost of debt, even without doing any mechanics, this number just doesn't make sense in this calculation, right? Why not? Take a look at the risk-free rate the guy is using, 5%. And in the same calculation, he's using a cost of debt that's actually lower than the risk-free rate. That cannot happen. But in a book interest rate, you can see why it happens, right? I borrowed money when rates were lower. I borrowed a lot of short-term debt. I can end up with a book interest rate that's actually lower than my risk-free rate. Again, the pushback there is, what are you going to do instead? Well, if you don't want to use a book interest rate and you don't have a rating, what did we do?
Artificial rating.
We created synthetic ratings based on interest coverage ratios or financial ratios. People have lent money long before ratings agencies were around. The fact that you don't have a rating doesn't mean you can't compute a default spread. One final point on the tax rate. When we do after-tax cost of debt, remember there are two tax rates, an effective tax rate and a marginal tax rate. Which tax rate should we use to get an after-tax cost of debt? After tax, and tell me the reason. Why do we use the marginal tax?
Your tax on the last dollar year.
Exactly, right? You can have all this low tax income all over the world, but guess where you're going to park your debt, where you get the maximum bang for your buck, where you get the highest tax benefit. That's why Apple keeps all its debt in the US, not in Ireland, not in Hong Kong. You're going to get the max to use the marginal tax rate. In fact, I took each calculation and I did that replacement. Oh, forgot to mention, oh, by the way, this company, even though it's a US company, does get 20% of its revenues in Brazil. This analyst, because it's a US company, used the US equity risk premium. But when we did equity risk premiums, we brought in the extra risk of being in a risky market, even though you're a developed market company. So I replaced the normalized with the current risk-free rate, the regression beta with the bottom-up beta, the historical risk premium with an implied premium, brought in the country risk of Brazil into my equity risk premium, removed the small cap premium. And then for the debt ratio, I went back to a much narrower definition of debt, which pushed down my debt ratio. and replace the cost of debt, which is a book interest rate, with a synthetic cost of debt based on their rating. Much higher cost of debt. My overall cost of capital was 12.6%, much, much higher than the 8.05% that the analysts estimated. What I'd like you to do is pick up a DCF that somebody has done, presumably somebody who claims to know what they're doing, break down the cost of capital into its parts and start pushing. Don't do it on your first day of work with your managing director's cost of capital. At least have the good sense to hold off on this, but you can still laugh behind your hand at the stupid things that people do. And then when you get a little further up the ladder, you could push for change. A lot of crap gets done in the name of cost of capital. About half of all valuations, you know what people get their numbers? They get them from management. They ask managers, give me cash flows. So I'm going to play the role of a management. I'm going to supply you with cash flows. And I want you to ask me questions about these cash flows, because you can't directly say your cash flows are wrong. Ask me the questions to see if these cash flows are possible, plausible, probable. So I'm projecting cash flows. I'm projecting a revenue growth rate of 10% for the next 4 years. My margins stay the same. So my margins are always 30% of revenues. I add back depreciation, subtract CapEx, subtract change in working capital. I get to free cash flow of the firm. So you ready? I'll show you those cash flows. And your job is to ask me questions that will tell you whether the cash flows are plausible or whether I'm violating consistency rules. What's the first question you're going to ask me? Let's start with growth. What are the kinds of questions you need to ask about growth? Go ahead.
What are you reinvesting to get that growth?
And I'm telling you, right? In fact, you don't even have to ask me. I'm assuming 20, if you look at my reinvestment, and the easiest way to get reinvestment is take the difference between my after-tax operating and my free cash flow. That's what all that CapEx, depreciation, working capital does. Every single year, it's 20% of my after-tax operating. So keep going. So I have a 10% growth rate and a 20% reinvestment rate. So you can already see it in my numbers. What does that imply in terms of return on capital on future projects? What am I implicitly assuming? 10% growth rate, reinvestment rate of 50%, I'm sorry, 20%. So my return on capital has to be 50%, right? You're one question away from imploding my cash flows. The only question you need to ask me is, what was my return on capital last year? And if I say it's 7%, then you have a follow-up question. What the heck is happening to you that allows you to go from 7% to 50%? And the answer is probably nothing, and I made up the reinvestment. When you see cash flows that are provided to you, you don't even have to ask questions about reinvestment. It's already in there, especially with these 500 line item discounted cash flow valuations. Look at the free cash flow, look at the after-tax operating income. The difference is what they're reinvesting. And check to see whether that's consistent with the kind of growth they're assuming. And on the 10% growth itself, you might want to ask me a question about how big is the market? What's your market share? If I tell you the market's not growing and I have an 80% market share, the question to ask is, where's this 10% growth coming from? You're already a large market share company. How do you get there? Those are the kinds of questions that we should all be asking ourselves when we value companies, but you should be asking other people when they push cash flows. Let's talk about the debt ratio and the cost of capital. The debt ratio enters because it sets a weights for debt and equity. So remember Hormel Foods, a company that we valued way back at the dark side of valuation? It's a company with 10% debt, 90% equity. The cost of equity was about 7.31%. The after-tax cost of debt was 2.36%. And the cost of capital I have is 6.8%. I get ready to value the company when another analyst whispers in my ear, you're supposed to use target debt ratios. I have no idea what the target debt ratio is, but he makes up a number. It should be 30%. We'll come back and address the question of whether you should move to a target debt ratio. But if you do move to a 30% target debt ratio, what will my cost of capital look like? Let me try something and you tell me whether I can do this. Can I just replace 0.9 with 0.7 and 0.1 with 0.3 and just recompute the cost of capital?
No.
Why not? Go ahead.
Your cost of debt would probably increase increase.
My cost of debt, 3 times. It's not probably. I triple my debt. Everybody's going to freak out, right? Ratings agencies, banks, my cost of debt will go up. What about the cost of equity? The reason we make this fixation, I know I've tortured you with this stupid Levitt beta formula. You hope you never see it again. But the reason I keep bringing it front and center, it's not because it's some magical potion. It's because it makes you think about what the effect is of borrowing money on your beta and your cost of equity. Guess what? If I go from 10% debt to 30% debt, my cost of equity is going to be higher. My cost of debt is going to be higher. What's going to happen to my cost of capital? Maybe it'll be lower, maybe it'll be higher. Depends on which effect dominates. In this case, it turns out that moving to a 30% debt ratio does lower my cost of capital. Should I use that though to value my company? Or when in investing, should I be using a target debt ratio to value a company as opposed to the actual debt ratio?
Well, if you think management is actually going to implement
One
that.
is that the management has a clear plan. It says, look, we're going to move it. The other is if you're an acquirer of the company, right? Because then you can set the debt ratio and say, look, I don't care what the management thinks about it. I'm going to fund this acquisition with 30% debt, 70% equity. If you're a passive investor, be very careful about using things like target debt ratios. You don't run the company. The management does. And they hate borrowing money. Guess what? You and I can think the target debt ratio is 40%, but it's completely irrelevant because they're never going to borrow the money. Let's talk about the elephant in the room, the terminal value. I'm going to restate a question I asked you during the terminal value discussion, but I want to make sure everybody's clear on this, because here again, be prepared to debate with people who will disagree with you. Remember, you get to the terminal value in year 5, year 10, whenever you think your company is, whenever you get tired of estimating cash flows. And there are 3 ways of estimating terminal value. One is to assume a growing perpetuity or a growing annuity and estimate what the terminal value will be in year 10 based on a 2% growth rate forever. The second is to use a shortcut, right? You got EBITDA in year 10, revenues in year 10, earnings in year 10, book value in year 10. Apply a multiple to it, 2 times book value, 8 times EBITDA. Usually obtained by looking at other companies in the sector that are more mature and applying it. The third is to end your company in year 10 and break it up into pieces and sell off the pieces for liquidation. Which of those 3 can you never use in a discounted cash flow valuation? Or should you never use? Can is such a weak word. And be ready for this is where the debate. 80% of banking DCFs use multiples to get terminal value. Get your arguments in line because you're going to get steamrolled by people above you saying, but that's the way we always tell me what's wrong with using a multiple to get the terminal value in a DCF. What's the essence of DCF? We're trying to estimate the value of something as a business based on its cash flows and growth, right? And the biggest number in your DCF is your terminal value. If I take something that's 80% of my value and base it on what other people are paying for similar companies, it's not a DCF, it's a forward pricing. There's nothing wrong with the forward pricing. In fact, some of you in pricing your companies, I gave you that suggestion, right? If you have a young company, don't try to put numbers into today's regression because you get strange looking pricing. Use the forward numbers. You are doing a forward pricing. But you are doing a pricing. You are not doing a discounted cash flow valuation. But as I said, get your arguments in line because this is something that is almost established practice in banking. Of just using a multiple, it's easier, it's simpler, and they'll give you all kinds of crap. Growth rate forever, it's a big deal, I can't make this. But remember, it's not the growth per se in your terminal value that drives your terminal value. It's what you assume with growth that determines that effect. In fact, to see how growth is not the key variable in your terminal value, let's assume I have a firm, which is $120 million in after-tax operating income, growing at a 0% growth rate in perpetuity. And my cost of capital is 10% because I'm all equity funded. It's 10% cost of equity in capital. 120 million after-tax operating income every year forever, 10% cost of capital. The present value is going to be 1.2 billion, right? 120 divided by 0.1. What if I told you that these cash flows, that this company is going to have 2% growth a year in perpetuity. What's going to happen to my terminal value? What are you tempted to do? Keep the 120 million, divide by 0.10 minus 0.02, which would give me, in fact, a terminal value of 1.6 billion, 120. If I make it 4%, I'll double the value. I mean, this is magical, right? I can make my terminal value any number by changing the growth rate. But what am I missing when I do that? When I put a 2% growth rate, remember my numerator was 120 million when I had zero growth? When I have a 2% growth rate, what should happen to my numerator to make it consistent? Need to reinvest. So what do I need to tell you or assume after you to be able to estimate that reinvestment? What your return on capital? What if I told you your return on capital is 10%? Then what's going to happen? Return on capital equal to your cost of capital. Guess what you're going to see? Your reinvestment will exactly offset what you assume about growth. Your terminal value will stay at 1.2 billion no matter what growth rate you use. Pull that ammunition out when you want to argue. When again somebody says the terminal value, I can make it any number I wanted to by playing with the growth rate. That's because you're playing with the growth rate. This is a business. You can't be playing with the growth rate. You got to be reinvesting enough to sustain that growth. That is part of what buying a business is, understanding what the competitive advantages are of this company, whether they'll fade over time. Because if they will fade over time, the terminal value is driven almost entirely by the earnings you have in year 10 and the cost of capital. The growth effect kind of dissipates. I'm going to take you back to quiz 2. Quiz 2, you had that cross-holding crap that threw you all over: add, subtract, multiply, divide. After a while, you have no idea what you were doing. Let's revisit that nightmare. Let's suppose I decide to do a valuation. I take free cash flow of the firm. I discount them back at the cost of capital. I come up with a present value of 100 million. So with each item, I've done the DCF part of the work. So I'm going to list items. With each one, I want you to tell me whether you're going to add this item, subtract this item, do nothing to this item, and why. Let's start with the first item, cash of 15 million. Add, subtract, do nothing, and why. What do I do with cash? Go ahead. And tell me why. Equity investors get everything at the end, right? What's special about cash that it's not in my valuation already? Right? I already did free cash flow of the firm, discounted the cost of capital. Why isn't cash already in there? Go ahead.
You're finding the value of your operating assets.
And what did I start with to get to free cash flow of the firm? What measure of earnings? EBIT, operating income. And the interest income from cash is not part of operating income. That's why we add cash back. It's actually a very simple rule. If something is not already in your operating income, guess what? You have to bring it in separately. It's not going to be in your valuation already. So we add cash back because the income from cash is not part of a free cash flow. What about debt? Add, subtract, or ignore to get to equity value. Let's subtract it out. If you ignore it, you're going to be in deep trouble, right? What if I have a 5% holding in another company? What is significant about that? It's a minority holding, right? When you have a minority holding, the income from that holding is not part of operating income. That's why going back to EBIT is always going to give you the tiebreaker. It's not part of operating income. And if it's not part of operating income, I haven't valued it yet. And preferably, I'd like to get a market value, not a book value. So if you have a way to get to market value, you want to get that. Here I did. 5% of 200 million is 10 million. I'm not going to take book value if I have market value. And finally, I look on the liability side, and I wish I hadn't because it says minority interest. But minority interest always shows up on the liability side. Subtract. And the reason is? You overcounted, right? You acted like you owned 100% when you own only 60%. You've actually counted something that doesn't belong to you in your free cash flow of the firm, and you're going to net it out. Follow that rule. Whenever you see a list of items that you're given after your DCF, those loose ends, go through each one and say, have I counted this already? In fact, let me add one more layer. Let's suppose that this company sits on real estate. Its factory is built on some very valuable real estate. And out of the value of that real estate is 80 million. Add, subtract, or ignore. Anybody want to give that a shot? Yes.
I think it would depend on whether the real estate produces value in terms of like,
The factory is sitting on it. That's what produces the cash flows. So there, I can't have my cake and eat it too, right? I can't count the cash flows and the real estate. And if the real estate rises above the 100 million, then I can ask, maybe I shouldn't be running this business in the first place. I can sell the real estate, but I can't have both in the same valuation. That would be double counting. So try that out as an exercise. Take items on the balance sheet. So why am I not counting this? Why do we not count goodwill? Why do we not count brand name? Because it's already in your DCF. Why do we count cash? Because it's not in your DCF. Okay. Value of the equity in this firm is going to be 100 plus 15 minus 20. So it's 95 plus 10. That'll make you back to 105 minus the 10, which brings you back to 95. Would your answer change if I told you the company is the target of a lawsuit? First, this is good news or bad news? If you own equity in a company and you open the paper and say, target in a lawsuit, you could potentially lose 100 million. Obviously bad news, right? So what would you try to go about estimating to bring that into your value? What do you have to figure?
Probability you
Get a good trial lawyer friend, no? The probability is 10%. 10% of 100 million is 10 million. This isn't rocket science. You're just protecting your equity stake and making sure that you've incorporated everything you need to worry about into that valuation. We're getting to the hardest layers of hell. Let's take the last two layers. Let's say you valued equity in a company at 200 million. The company has 10 million shares outstanding. Easy part of the question. So what's your value per share? 200 divided by 10 is $20, right? No, sir, by the way, I forgot. Just yesterday, I gave 2 million options to the CEO. Why? I like the guy. But don't worry, it costs you nothing because the exercise price on the options is set equal to the current stock price. Basically, there's no exercise value. As an equity investor in this company, are you now worse off, as well off, or better off than before I told you this information? Worse off. Why? Because I've given away 2 million options, and they're definitely not worth nothing because an at-the-money option with 10 years left to expiration is worth a lot of money. So what should I do here to clean up for that? When you have options outstanding? Subtract the value of the option, not the exercise value, but the actual value. That's the whole point of having that option pricing worksheet in there is you need to actually build in the time premium, and that's what option pricing models try to do. You subtract the value of the options, and then you divide by the remaining share, by the actual number of shares outstanding. The alternative approach, the treasury stock approach, is not going to work here. Do you see why? Because if I add the exercise proceeds and divide by 120, I'm going to say nothing happened. I'm still okay, $20 per share. That's the limitation of the treasury stock approach, is it ignores the time premium on the option. So you ready for the hardest layer of hell? I've called it the Wasserstein-Perella special layer of hell. Now, whether you remember, but at the start of session 3, I showed you these cash flows that First Boston had used in evaluation. I went through the cash flows, and it's too difficult to read the small print there, but the way they computed the cash flows, they started with net income. Already I'm giving you a clue as to where I'm ending up, right? Net income is equity income. They subtracted out CapEx, but they also subtracted out debt payments. So when you start with net income and subtract out debt payments, you end up with cash flows to equity. This is an acquisition. They've come up with cash flows to equity for the target firm. The right discount rate they should have used should have been the cost of equity for the target firm. Remember the whole M&A process of focusing on the target firm? You remember what they used instead? First Boston, leading M&A banker on the street. They used the wrong company and the wrong discount rate, about as far as you can get from the right answer if you were trying. Use a 10.5% discount rate instead of a 16.5% discount rate. You end up with an $800 million value instead of a $400 million value. And here it had consequences. The acquirer, Carborundum, ended up paying $600 million for this company. They paid $200 million more than the valuation should have suggested they did if the right discount rate had been used. So let's talk about what you will see next are the numbers you put in. Some of your numbers I looked at and said, maybe they put an extra zero, maybe they forgot a zero. So you were entering numbers late. I don't know what you were, or no, some numbers might have slipped through. So like one of those disclosure things that you see in investment banking emails, which is don't believe everything I said, like a page and a half of things could have gone wrong. It's not my fault. And it's really not my fault. These are your numbers. So what I thought I'd do is I'd go through, I had 302 people who submitted their numbers. Incidentally, if you're one of those 18 or 20 people who hasn't, I don't want to take away 5 points from you, especially since you've done the work. So get it in, please. I'll still, so this is, I can't obviously include you in the presentation, but try to get it in before, as you turn in your final project, so you can nail those 5 points down. So I started by looking at which companies were picked the most frequently in evaluations. Top of the list, Netflix. You know how I think you guys pick companies? You put it off and you put it off, and it's late in the evening, you're watching Netflix. So I haven't picked a company. Let me do Netflix. Yeah? For the longest time, Krispy Kreme was one of the most most frequently. What the heck? You're probably sitting there stuffing your face with Krispy Kreme. So what company should I use? Oh, by the way, there's Krispy Kreme. Let me pick that. Lululemon. I wish the company would just cease to exist. What is it with Lululemon and fixation with valuing this company? But you can see there are, lots of companies where multiple people value the company. Now, early in this class, a few of you emailed me saying, I'm looking at the master spreadsheet. There's somebody else who's valuing the company I want to value. Should I pick a different company? And I said, don't worry. You know why you shouldn't worry? I took the 11 people who valued Netflix. This is from your summaries. Take a look at what you told me about Netflix, and you can see already why I don't care. If 50 people value Netflix. First, some of you were, there's a difference in timing. And in this market, 10 days can make a huge difference, right? 428 versus 5.8, the price moved a lot. Second, and you can see it in the price per share. There's the DCF values, and you can see a range in values. The low end, I think, is 128, and the highest value might be 233. You're saying which one is right? Hey, different stories. Some of these are going to be more right than others in hindsight, but you can see different stories give you different numbers. On the pricing, you can see multiples, EV to sales, EV to EBITDA, some EV to revenue, same thing. A couple of price to book ratios. So different choices. And the pricing is even more volatile than the DCF value. And on the recommendation, let's see, 1, 2, 3, 4, 5, 6, 7. 7 buys, 3 sells, and 2 holds. There could be 50 people doing this, and you will still have disagreement. Does that surprise me? Not in the least. Markets are built around disagreement. That's how you get buyers and sellers. And valuation, of course, you're going to get disagreements about the same company. Here's what you found when you valued your company. So I took your DCF value, I compared to the price. Your median company was pretty close to fairly priced. It was minus 2.08%. So minus 2 means it's slightly undervalued. So a negative number means the value is higher than the price. I'm comparing the price to the value. So it's an undervalued stock. In fact, you broke down almost 52.5% of your companies were undervalued, 48% were overvalued. So slightly more undervalued companies than overvalued companies. And you can see there's a range. There are companies, the 25th percentile, the company 21% undervalued, and there are companies which are 80, 90, 95% undervalued. In fact, you can see there are about 22 companies which are overvalued by more than 100%, and about 11 companies undervalued by greater than 50%. So you want to see the list of the most undervalued companies? Here's your most undervalued companies. I don't know whether the same person entered Upstart twice, or 2 different people are valuing it pretty close to the same value. That looks like you work as a team there on your DCF. But the pricing is very different. So maybe you diverge on the pricing. So those are the lists of most undervalued stocks. I don't know whether I ever told you about the deal I've made with my valuation classes. It's an implicit deal. I should have mentioned this. Every semester, I pick one company from this list to buy. You're saying, how do I pick it? I don't read your DCFs and look into depth. Actually, I will send an email, or you can send me an email. If your company's on this list, here's all you need to send me an email. I am buying. If you're buying, I'm buying. If you're not buying, don't even tell me about how much you believe in this company, how much conviction you have. I don't care. If you don't have the conviction to buy, I'm not buying. You know? And I've done this for as long as I've been teaching this classes. Every semester, I buy one from them. I don't sell short any of the overvalued stocks, and you're going to see in a moment why. But these are the most overvalued companies on your list. You can see, you know, huge difference between price and DCF. BlackBerry, your DCF value is 55 cents. The price per share is 582. Actually, let me take that back. There were 4 companies with the DCF value was 0. So I had to take them out because you can't compute the percentage difference if you have a 0 number there. But there are companies where you don't think the company is worth very much on a DCF basis when market disagrees with you. Now, as I said, I buy one stock. This is not a charitable donation that I'm making every year. The reason I do it is there's a history. I've been teaching this class now for 36 years. I've kept track of the buys and sells based on your recommendations now going back in time. So what I have in this graph are actually the buys and the sells. The hold, I don't care. There's chicken. I don't even know where to put you. The red is, of course, the S&P 500. On average, if we'd been running a mutual fund and we were able to trade at the prices you stated on your, we'd be doing pretty well. The buys have done, over time, significantly better than the sells, and they've beaten the market. But I'll give you a little insight into these excess returns. So first is, it's on average, right? It's not like every buy pays off and every sell pays off. About 60% of buys go up more than the market, but so do 45% of sells. There's a difference, but it's not like you get 100% of buys go up and 100% of sells go down. On average, you're right. Second, there are big differences across types of companies. The buys on small and emerging market companies seem to have more capacity to find undervaluation than the buys on big name, large cap companies. No surprise there, right? Because you're often working with more differential information. Third, the big winners are what keep these portfolios afloat. In other words, there's 1 or 2 companies in every class's undervalued list that carries the entire portfolio. In 1998, it was Apple, one of the most undervalued. In 2013, it was Microsoft that carried it for the next 5 years. And there's a lesson there for investors. When people succeed in investing, it's not because every stock they pick beats the market. It's because 2 or 3 stocks they pick beat the market by a lot and they carry the entire portfolio. Which means if you shed those stocks too early, you can end up taking away the reasons you're going to end up beating the market. And one final point, and I found this interesting, is stocks which were both undervalued and underpriced. Remember, I asked you, value and price. If you found a stock to be both undervalued and underpriced, it did much better than a stock that was just undervalued. I'm a true believer in intrinsic valuation, but I do pricing. I do pricing because why have just one force working for me when I can have 2? So don't make this an either or. I've heard people say, I do only intrinsic valuation. Why? Why not just look at the pricing? So even if you didn't like the pricing part, it's not what you do, start to understand it because it is part of investing and it seems to improve your odds of success. So let's talk a little bit about pricing. Remember that 4-step deconstruction process? Let me go through it again. Start by defining the multiple. Don't assume that if you say PE and I say PE, we're talking about the same thing. At the risk of sounding stupid, say, could you please explain to me how you compute EV to EBITDA? You'd be surprised. And you probably shouldn't be after you've seen, you notice in S&P Capital IQ, the way they compute EV is not the same way you compute EV. You say, where the heck did they come up with those numbers? So at the risk of sounding stupid, make sure you're talking. So in the definitional part, there were 2 tests we had. Is it consistently defined? You remember that? Numerator is an equity value. Denominator has to be an equity value. Numerator is an enterprise value. Denominator has to be an enterprise value. Second, describe the multiple. Don't fall into this lazy 8 times EBITDA is cheap, using the average and median. We have all of the data in front of us now. Play some Moneyball. Get a poster of Jonah Hill, put it up in your room, and say every time they're tempted to use the average, look at Jonah Hill and Moneyball and say, I can do that better. Define, describe, analyze. Whenever you are wondering what are the variables that drive a multiple, you don't have to go check your notes. Go back to a discounted cash flow model, and embedded in that model are all of the variables that drive a multiple. P, it's growth, payout, cost of equity. Price to book, it's all 3 plus price to book. And again, you can start from scratch and derive those variables very simply by going back to discounted cash flow model. And then when you get to apply, don't get locked into sectors and geographies. Don't say, I have a US steel company, I can compare it only to US steel companies. Now, when you value Netflix, for example, 11 people, I'm sure you ran into this question. If you define Netflix as a subscription-based entertainment company, your sample size already shrinks, right? How many? Maybe you can get Spotify, Pandora, but beyond that, you're going to have a really tough time finding companies. Define broadly and control for differences. That's a whole advantage of bringing statistics into the process, is it allows you to control for differences. Define, describe, analyze, apply. I pulled the page out of your packet too. It's a page you've seen before, where I essentially took every multiple that we run into commonly and went back to a discounted cash flow model to extract the variables that drive the multiple. With equity multiples, you go back to a dividend discount model. With firm multiples, you go back to a firm valuation model. Keep it simple for the algebra. Make it a stable growth model. And you can derive what determines EV to EBITDA, EV to sales, EV to invested capital. So rather than think of these as 10 different equations, which is what will show up in the notes, think of it as one equation with algebra giving me 10 different variations of the same thing. To ask you to pick multiples, you probably are not going to be surprised here. You guys love EV to sales multiples. Part of it is desperation. You're valuing a money-losing company, you have no choice. But you probably also discovered that when you try to explain multiples, it's easier to explain EV to sales with margins than pretty much any other multiple. You know what? You don't have any accounting intervention. Every other multiple, there's an accountant in the middle, right? They screw things up. Invested capital, book value, net income, earnings. You say, get those guys out of the room. Let's go back to basics, because then you're looking at revenues and EV. It comes with catches. You got to control for things. But about half of you are EV to sales, followed by EV to EBITDA. There's some accounting damage, but it's limited, right? In fact, notice the further into the accounting statements you go, the more tricky it becomes actually using a multiple. Price earnings and price to book is now kind of almost gone. That wasn't the case 30 or 40 years ago. The bulk of the companies that were being valued in this class were manufacturing companies or traditional companies. You could get away using PE price book. You are valuing mature companies in smokestack businesses. So as we move away from that into technology, into companies with intangible assets, this is exactly what you should expect to see happen. And in terms of pricing, here's the first thing I did. I took your DCF value and you took your pricing per share based on multiple, and I compared the two to see which one was higher. Because the mythology is DCF is conservative. It'll always give you the lower value. That's not true. For about half of you, the DCF value is higher. For the other half, the DCF value is lower. So if you had a DCF value lower than pricing, don't extrapolate from that and expect to see that every single time. It just happened to be true for the company you picked, because at least in this group, it turns out that you get about half. So basically, if you see less than 100%, that means the DCF value is less than the pricing. More than 100%, the DCF value is higher than the pricing. So it can cut both ways. And if you compare your pricing to the actual price to see if it's underpriced or overpriced, the median company was underpriced by about 2%. So just like your DCF value, you're coming in pretty close to the current market price. Here are your most underpriced stocks. So basically, I took your pricing compared to the actual price per share. So Caesars, the price per share is 59. according to you, and as I said, I will take you at your number, the price per share should be 1,096. Either you've been gambling way too much. You know, what was that? You know, Kentucky Derby, 80-1 odds. Maybe you won a lot of money and this is where it's going to pay off. But you know, so maybe that's just an artifact of something in your EV to EBITDA. But basically all I'm doing is comparing your price per share to the pricing you're getting with your multiple. There's the price as a percentage of your pricing. In terms of overpriced, I guess I shouldn't be surprised to see DD up on top. But DD's DCF value, whoever did DD, was actually pretty close to price per share. But if you try to price per share based on price to book, you're getting close to zero. So again, it's very specific to many of these companies. And you notice that if you look across the recommendation, there are actually 3 buys among the most overpriced stocks. Why? Because your DCF value pushed in the other direction and you're going with your DCF value. And in fact, many of you, when you did your pricing, felt, so my regression's not working. In fact, the common refrain I heard on Friday and Saturday is, I'm running a regression. I've tried everything. I can't get the R squared above 12%. What am I doing wrong? You can't get blood from a stone. If your data doesn't give you a high R squared, you can't make the R squared higher by wishing a higher R squared, by putting more variables in. So my advice was the same, and I'll broadcast the advice, which is when you get a low R squared, it doesn't mean you cannot make a prediction. Your prediction just comes with a lot of range, a lot of noise. It means you don't have to trust that pricing when you make your recommendation. You get to pick what you want to hang your hat on. And if the pricing is very uncertain, you say, look, I'm not going to trust the pricing. There were 45 companies in the class where you were able to apply an option pricing model. Remember the 2 conditions you needed for option pricing to work, because it was distressed equities. First is you needed to be a money-losing company. Second is you needed to carry a lot of debt. Many of you had one or the other, but 1 out of 2 doesn't do it. You need both. So it's a small subset of companies. For those 45 companies, using an option pricing model gave a premium of 36% of your DCF value. This is why people like options. It allows you to take a DCF value and adds a premium to it. And the premium is coming from the fact they have uncertainty about the future. Risk now becomes your ally. So you're running a vulture investing fund. That is your perspective on equity, is the options that you're getting and hoping that some of them pay off enough to cover the rest. So you got to that final stage of buy, sell, or hold. Like Hamlet, some of you got done on Tuesday. You couldn't make up your mind on buy, sell, or hold for 5 full days. I think you were expecting a revelation in the middle of the night saying, go buy, go sell. But the reality is it doesn't come, right? Because here are the 3 places you are. One is you're not sure yet. The only promise, you will never be sure. Sure is not a word we use in investing. You play the odds, and at some point in time, you got to be willing to pull the trigger. But it's natural to feel uncertain and not sure about what to do. Second, some of you, this might have been enough of an experience to bring you back to the belief that markets are efficient. Because you might have walked in saying markets are stupid, they don't know what they're doing. And now you're saying, maybe they're not that stupid. Maybe this is a little messier than I thought it was. Because if you think about it, markets are amazing mechanisms, right? You got tens of thousands, millions of people coming together in a marketplace with different beliefs, and you have a clearing price. Yeah? I mean, you like Yelp for your restaurants. You should like markets for prices, right? Think of the millions of people putting their input in. It's when people talk about crowd wisdom, now acting like Silicon Valley invented this in 2005. Hey, we've had crowd wisdom in markets for as long as markets have been around. And we know what crowds do well. We also know what they do badly. Now, the one thing about markets is you can disagree with markets, but don't disrespect them, don't ignore them. There's always information in the marketplace. So there are your recommendations. 49% buys. There are 143 buys, or 148 buys. 14%, I'm sorry, that should be flipped around. 14% hold and 37% sell. So cross out the hold and the sell reversed. So for every 3 sells, there were about 4 to 5 buys. Wonder whether this is always the case? Here's what it looked like. last spring. There were 88 sells and 42 buys. There were twice as many sells and buys. You're either a more optimistic bunch, or there's a much easier explanation, right? Last year, people were valuing companies into a rising market. This year, you're valuing companies into a falling market. I'll wager if we'd stopped this class in February and you turned in your DCFs, assuming you're done, that you wouldn't have as many buys as you have today. I mean, take a look at what your DCF value is relative to the price 6 weeks ago in your company. And many of your recommendations would have shifted. So I said there were 3 ways you can put a number on a company, right? Intrinsic valuation, pricing, and perhaps options. You're saying, which one should I use? First, it depends on the asset. If you have a non-marketable asset, which is unique, you can't do pricing because you can't have other assets that are traded out there. You got to get some kind of appraiser come in and come up with a number, and you have no idea of checking the number. And also it depends on whether your asset has capacity. I mean, you can't value Bitcoin. I've mentioned this before because it doesn't generate cash flows, but you can value Coinbase because it's a business built around Bitcoin. So the first is it'll depend on the asset you are trying to. It'll also depend on you. Why? Remember, time horizon matters. If you have a long time horizon, you're a much better candidate for doing intrinsic valuation. If you have a short time horizon, you're a much better candidate for pricing. It depends on why you're doing the valuation. If you're doing it for a transaction, trust me, you should be pricing things. Transactions are about pricing. If you're investing in a business long term, you can do valuation. And finally, it also depends on how you think markets make mistakes. I'll repeat what I said very early in this class. If you think markets make mistakes and correct them over time, then intrinsic valuation works for you. If you think markets are right on average, but are wrong across stocks, pricing is a much better tactic because you're trying to take advantage of mispricing across securities. So I can't tell you what's right for you. You've got to come to that conclusion, and you've just started the journey. Don't beat yourself up saying, I'm not done, I can't make up my mind now. Everything you learn from this point on about markets will feed into that decision of whether you become a trader or an investor. Traders play the pricing game, investors play the value game. And what's right for you is really something you've got to decide for yourself. So this is a question I asked you in the second session. Hopefully, you don't have to tell me the answer. But if you remember, I said, you're entering a class, you've never done valuation. Which one would you go with? I want you to revisit that question based on your experiences that you had in valuing companies and pricing them. And be honest with yourself. You don't have to pick intrinsic valuation because I like intrinsic valuation. You have to decide for yourself what you felt more comfortable doing. Some of you were not that comfortable doing discounted cash flow valuation, but you were much more comfortable with the statistics of pricing. It seemed much more objective. Face up to it. You're much better. If that's what makes you comfortable, that's what you should be picking. And I also made this big deal about storytelling and number crunching and asked you to think about what your strength is. And the advice I gave then, which I'll repeat again, is work on your weak side. If you're naturally a storyteller, I hope this class has given you a chance to at least start to understand numbers are not that scary. That actually using numbers will make you a better storyteller. So even if your plan is to be a strategist, not an appraiser, not an valuation, this will make you a better strategist, being comfortable with numbers. For those of you who came in as natural number crunchers, I know it was really, really difficult. I had to eke those stories out of you. How many DCF feedbacks that I have to give you? Please fill in the story. Don't give me an 18% revenue growth rate. Okay? And I know it wasn't easy, but keep working on it because if you get better at storytelling, you'll actually become a better number cruncher. So the end game I stated earlier, either be a disciplined storyteller or an imaginative number cruncher. That's the combination you need to do valuation. You need both sides of your brain working. I don't like to dish out advice, so I'll give you minimalist advice. Now, every time I hear people say, there's been a paradigm shift, the old fundamentals don't matter. Guess what? We get a reminder again, the fundamentals do matter. Last Friday, I wrote about inflation, interest rates, and the S&P 500. Nothing magical. You've heard me, after this class, everything you see there, you've heard me say. And I said, right now, if you look at where the market is, there are three things that are going to drive this market. And the three things are always the same three things. First is, where will T-bond rates end up? Right now, they've got 3%. They've gone up from 1.5 to 3%. Will they stay at 3? Will they go to 4 or 5? The second is, equity risk premium started the year at 4.24%. They're now at almost 5.2%. That's a big move in equity risk premiums in a mature market. Are we done? Is this the steady state, or we're going to go further up? And the third is about earnings. Earnings have been pumped up over the last year and a half as the economy has come back. The question is there a recession around the corner that could cause the earnings to collapse? And driving all three is one macro variable, which is inflation. If inflation stays at 5%, guess what? T-bond rates are going to go to 5%. Whether the Fed wants it or not is completely irrelevant. If inflation goes to 5%, risk premiums are going to rise because 5% inflation comes with much more uncertainty about the future, about future inflation. And if inflation stays at 5%, you're almost guaranteed to have a recession because the only way the Fed can fight that inflation is by putting us into a severe recession. You have three variables, but one macro variable driving all of those. So I don't know where we will end up, but inflation is going to be the driver of every single big move in the market. And you're going to see volatility like you've seen in the last weeks as people try to figure out where steady state is. We've been spoiled. We've been spoiled by a decade of low and stable inflation. There are people in this market who've never known a market without low and stable inflation. And sometimes you got to feel it to really realize how corrosive inflation is in terms of affecting everything you do. Second, you're going to end up especially if you end up in valuation, looking at these 500-line spreadsheets with 3 statements forecast out for the next 25 years. Focus on the big picture. Always step back and ask, what are we assuming about growth? What are we assuming about reinvestment? Try to consolidate so you know whether the valuations are sensible or not. You might have no choice but to do 500 line items because that's what your managing director likes to see. But that doesn't mean you can't create a secret compressed spreadsheet where you take your 500 line items and make them into 3, right? Because that's what's going to allow you to get a sense of, is something going wrong with my valuation? Third, you have all these old people sitting around saying, I've been in this market 40 years. Let me tell you about what I did in 1981. 1981, the guy's probably pretty close to death anyway. So let him tell his story so he can move on. But 20 years ago in the dot-com boom, anecdotes, especially in financial markets, mean absolutely nothing. Right? They're just stories. You really need to, and we have the data now. Let's stop using these anecdotes to come up with rules of thumb that get us into trouble. Fourth, keep your perspective. It's just the valuation. What's the worst that can happen? It's only money. If your reaction is, what else is there in life? You need some spiritual counseling, but I'm in no position to give it to you. Talk to your priest, your rabbi, whoever I still remember about 15 years ago, at the end of one of these second year, it was an MBA evaluation class. Second year MBA comes up to me. She was a history major from Yale who came back to business school. And usually if you're a history major from Yale, you take what's called the strategic route. You know what that is? Pick every class with the word strategic in the name. You can get through 2 years of an MBA without ever seeing a number. She ended up by accident, I think, in my valuation class because it's not a strategic valuation class and turned out to be pretty good at it. And in the class, she comes up and she says, I never thought this would happen, but I have a job as a sell-side equity research analyst. I said, my condolences. No, I said, congratulations. And then she said, I'm really scared. I said, what are you so scared about? She said, what if I make a mistake? I said, if you make a mistake, be glad you're not a brain surgeon. If you make a mistake, somebody dies on the table. You're an equity research analyst, you make a mistake. What's the worst that's going to happen? Somebody gets a little richer. Somebody else gets a little poorer. Just make sure that somebody who's getting a little poorer is not you. That's the only rule. Think like a Marxist. You move some wealth around. The world hasn't ended. Move on. Nothing in valuation is worth losing sleep over. Nothing in valuation is worth having fights over. So if somebody wants to come up with a strange concocted version of free cash flow, use a terminal value multiple, just let them go. It's not worth the fight. And finally, if you're looking for the magic ingredient, will set you apart as a successful investor. I have some really bad news. It's not skill. It's not the capacity to do DCFs. It's luck. If you're lucky, you can be completely sloppy and get away with it. If you're not, you're screwed no matter how much you know about valuation. Luck is the dominant paradigm in markets. Now, much as we'd like to think it's skill, you take the most successful investors of the last 30 years, my first reaction is you're lucky bastards. And then I'll dig a little deeper. Oh, maybe it wasn't luck. But luck is going to be the starting point for why you see success and failure in financial markets, in trading, because so much is out of your control. I'll close with an anecdote about luck. It's about my mother-in-law. She came to visit in early 2000. And she would drive us crazy. At that time, I wasn't even CNBC. There was some financial news channel she would turn on. She'd watch the ticker go. And every time one of our stocks went in the ticker, she'd say, go, Cisco, go. And convinced I was pushing up the stock price. Yeah? And all day long, all she would talk about what was in a portfolio, what was out of a portfolio, and I'd act like I was interested. That's what son-in-laws do. And then she let it slip that she owned this stock called Qualcomm, which in 2000 was one of the great success stories of 1999, up 600%. I was impressed. I said, Judy, how do you pick Qualcomm? I knew the minute I asked this question, I shouldn't have, because she told me. She said she picked Qualcomm because it owned MCI. And I said, that's not Qualcomm, that's WorldCom. She says, Qualcomm, WorldCom, what's the difference? I said, you bought the wrong stock. If you bought WorldCom instead, you'd have been down 30%. So you buy some stock that rhymes with it. After she left, I tried a strategy, pick a stock in the news, pick one that rhymes with it. You know what? If I'd made a lot of money, forget about this intrinsic value cash flow stuff. This class would have been called the rhyming stock class. So we'd have come, pick a stock in the news, pick one that rhymes with it. Now, I was afraid to ask her after that why she owns Cisco. Afraid the answer might be she really likes the vegetable oil, or Saturday Night Live, or whatever else. Who knows what drove that particular decision. So be lucky. That's my parting wish for you. Be lucky. But be lucky on your final exams first before you get lucky in investing. So I would see you on Wednesday at 4 o'clock. Take care.
Professor.
I've been asked to remind you that there are CFEs floating for this class that I think the due date is tomorrow. So if you haven't done the CFE for the class, I really don't care. I've been told that if I don't say this, I'm not doing my duty. So I'm done. So yes. Email me what? I gave you the instructions, right? It's emailed as the subject matter. So go back and read your emails. It tells you not only do you need to email me, you need to specify the subject, the fat lady is singing. So it will be emailed. You're welcome. Absolutely. Yeah. Sure. You're welcome. Take care. Bye-bye. Yeah. Take it, as I said, I told everyone that's the inflation. It's an inflation-driven market. Until inflation reaches some steady state, when we say this is what it's going to be, even if it's a higher number, we're going to get a lot of back and forth in this market. Yeah. Yeah.
Yeah. So I'm just gonna.
It's only one time. It's only one time inflation has really gone above 5% in, say, the 1970s. It's a sample size of one in the US. Beyond that, it's very tricky. We've never, you have to go back 100 years. So basically, any rule of thumb based on the past, not going to work. I read the Summers paper on inflation being greater than 5% and unemployment being less than 4%. And within 12 to 24 months, it's always been followed by a recession, but it's like 3 incidents or 2 incidents. So it's it looks impressive. It says 100% of the time, but 100% of 2 is still 2, right? it's not like 22 times it's happened. Yeah, so I don't know whether that's going to help that much. So I think we're going to have to figure it out. I think nobody really has a clear idea. Yeah. Congratulations. Yeah. Where are you going to be working? Okay. 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 Good luck to you. Yeah, take care. Hey, how are you? You're welcome.
You didn't have most recent.
Congratulations. I do one session for them. I do one session in the spring. This year, I did it in what I did the ESG session for them. Yeah.
Yeah. I remember. No, I'm not in line. I remember everything, but it's cool. Like, what are you waiting for? It's a cool thing to be like, yeah, I got that shot. It's a cool thing to be like, yo, wait, hey, what does this mean? Like somebody asks you a question. 300 sit there. Yeah, I have no idea. You have to go figure it out yourself. Okay, like jog your memory. I mean, it's like, yeah, like, oh yeah, for sure. Like, it was, you know, it's cool. Final went, Italian went terrible. Really hoping I graduate. I don't think it's gonna be that bad because it's only 20% of the grade. Why did you go in? Because I'm going to Italy. Like, my family's Italian. I've never met my family in Italy before, and I was like, you know, yeah. I was stupid, but that happens to me. I think I'll be all right. I think it'll be good enough. That's what I sent her an email right after. I'm like, thank you so much for teaching me. Like, we're gonna try to get all the participation.
Honestly, the only class that I'm worried about, like, the only class that actually really was failing was that cohort concept. No, my first I can't say that like my best power right now because I don't think so. No.
You're just cracking it. Wow, that's great. Nailed that one for sure. I sent the whole email in Italian. Our final on Wednesday. So actually, it's not I'm a little upset. So here, full course. No problem. It's sorry, probably July. Still like I get good. I know. So I'm studying that, and if I do well, right, just gonna keep going. My opinion, yeah, supposed to be doing sponsored. I'm not gonna jinx it. Yeah. Like it's developing pretty fast. My friend was at Solid. Figure it out. I'm all good now. Let's do it because I was going to Italy. I thought it would be a good way to learn. Like, I know a lot now. Whatever. All that. Nice. Yeah, that's it. So I'm gonna remember too. That's all you need to know. That's the funny thing though. First I go after graduation, I need to relearn Spanish like next week. Then I have to learn. Which one? Italian. Yeah.
No, that was him. That was him.
Good luck with the exam. Yeah. I think like I don't know if they're going to do part of undertaking Thursday when the next first night, free shop and you walk in, $8 drinks till midnight. So like 10 to 7. Yeah, and then I exit Toronto. This is the $100 an hour for DJs. Yeah, no, I have Ron has to get my track. Ron has to call if there's anyone else. Oh yeah, there's other kid. They're from 94. I see it like they used to be without being a show. I see you next. See you next. Good luck, guys. Appreciate it.
You know what, the numbers are comfortable. The more you see of the numbers, the more comfortable. The more you really have no basis. But yeah. I imagine how it's going to be like I guess, yeah, people like this. I want you to like. Then you can get an extra 24 hours. Not. Yeah. I'll take that.